how you can identify turning points in the market using Fibonacci and understanding what Fibonacci retracements are. Now, Fibonacci retracements are ratios used to identify potential reversal levels. These ratios are found in the Fibonacci sequence. The most popular of these retracement levels are 61.8 and 38.2. And you need to memorize those numbers. Now, there are a huge range of Fibonacci retracements or Fibonacci levels and Fibonacci calculations. But for trading, the ones were most important is 61.8 and 38.2, and then 50%, although 50% of a retracement is not a Fibonacci number as part of the Fibonacci sequence, but because it's such a popular retracement percentage, it's been added into our Fibonacci retracements. So we have 38.2, 50, and 61.8. Now, these retracements can be combined with other indicators and price patterns to create an overall strategy. So let's go back and figure out where these come from. Now, this class is not designed to delve too deep into the mathematic properties behind the Fibonacci sequence and the golden ratio. There are plenty of other sources for these details. And in fact, Fibonacci's were not developed for the trading market, and they exist in all of nature. Now, the way we actually get each Fibonacci level is by combining the previous levels. So in other words, we start out with 0 and add that to 1. What do we have? We have 1. We add the last 2 digits, 1 and 1 together, we get 2. When we add 1 and 2 together, we get 3. When we add 2 and 3 together, we get 5. If we add 3 and 5 together, we get 8. We add the 5 and 3 together, we get 13, and so on and so on and so on. And this is where these Fibonacci numbers come from, these Fibonacci sequence. Okay. This sequence then is broken into or combined into give us these ratios. Okay. Now, they can be derived in a complex mathematical sequence, but it really comes down to a pretty easy way to remember. Okay. So remember, we had our numbers which are 0, 1, 1, 2, 2, 3, 3, 5, 8, 13. Remember, we saw that all in the initial Fibonacci sequence we were just looking at. So if we were to take a number and divide it by the previous number. So in other words, if we take 21 and 13, which are right here, part of C, and we can just take random, whichever ones we want, and we divide the 21 by the 13, divide the number on the right by the number on the left, it's always going to equal about 1.61. which makes that one of the Fibonacci ratios. But since that's more than 100, it becomes what we call an extension. Okay. But if we were to go back and take the 13 and the 21 and divide it the opposite direction, divide the 13 by the 21, that'll give us 619 or 6176 or 6181. So that's where we come up with the 61.8 level. If we were to take a number and divide it by a number 2 places over, so instead of using 13 and 21, we were to use, say, 5 or 13 and 34, which is 2 places. It skips to 21 and goes 2 places over. That division number will give us 38.2. 21 and 55 will give us 38.1, so on and so forth. And that gives us the 38.2. So if we were to take 1, if we also take 1, number 1, and subtract this number, the 61.8 average, guess what? It gives us 38.2. So we either get 38.2 from the division, and it's also consequentially the number 1 minus 61.8. And this is where these numbers come from to make up what's called the ratio. And This ratio is used to determine levels of the current trend because it's based on the fact that the previous trend will retrace itself 38.2, 50% or 61% of the previous move. Let me just get all these markings off my. Okay. Now, 161.8 refers to what's called the golden ratio or the golden mean, or sometimes called phi. The inverse of 161.8 is 0.618. These ratios can be found throughout nature, architecture, and art. Okay. The proportion of the 0.618 to 1 is a mathematical basis for the shape of playing cards, for the Parthenon in Greece, for sunflowers, for snail shells, for Greek vases, and the spiral of galaxies from outer space. The Greeks based most of their art and architecture on this proportion, and they called it the golden mean. But this number or this mean or this average or this ratio can be found throughout the universe. And part of that universe is the financial markets and prices on charts. So we see these Fibonacci retracements in price movements, as well as we see it in outer space or the distance between our nose, ears, and mouth. So an asset will often pull back or retrace a percentage of its previous move before reversing. These Fibonacci retracements often occur at the levels of 38.2, 50%, and 61.8. Actually, the 50% level really does not have anything to do with Fibonacci, but traders use this level because of the tendency of stocks to retrace or reverse after retracing half of the previous move. So in other words, when we see a price movement, especially when price is moving in trends, we would expect price to be moving up, and then it will ease back down, and it can ease down 38.2% of, or to the 50% level of this previous move, or 61.8% of this previous move. Now, there's no rule, there's no law, there's no percentage, but if you're looking at price move and you're trying to figure out whether the markets are in a healthy trend and simply retracing, or they're about to reverse, we would use these important levels to predict price. It would also help us to predict when we would want to enter the market and when we want to exit and when we would want to panic. So the picture that I show you shows a graphical representation of reversal points for an asset in an uptrend. The pattern is reversed as the assets that are in a downtrend. After a stock makes a move to the upside, A, it can then retrace part of that move before moving on again in the desired direction. These retracements or pullbacks are what you as a swing trader want to watch for when to initiate a position. Now, if you were trading and you were in the market already and price was moving up, you're very happy. But the markets don't move in a straight line this way. Okay, they just don't. They retrace because at some point, the price reaches a level where the people who entered the market here decide they've already got preset target points or close orders. They're moving out of the market and booking their profits. Also, you have buyers who are moving to the sidelines because they're saying the price is too high. They just say it's pushed up too low. So they still believe in the price moving up, but they don't want to buy at this level. So between these combinations, the market eases down and allows all the traders that want to sell out of the market to get out of the market and book their profits. And the markets are waiting for those buyers who are sidelined to say, okay, we think the price is low enough that we will re-enter the market. Okay. They may not re-enter at 38.2. They may wait to this level and say, now we feel comfortable price is low enough for us to start buying in. But sometimes they don't. and the price could fall down to this level. But these are three important levels. If there's going to be a retracement, it's going to be at one of these levels. So once the asset begins to pull back or retrace, then you can plot these retracement levels on a chart to look for signs of a reversal. You do not automatically buy the stock just because it's at a common retracement level. Wait and look for candlestick patterns to develop at the 38.2. If you don't see any sign of reversal, then it may go back down to the 50% level. Look for a reversal there. If you do not see it, or when the stock reverses at a Fibonacci level, you just mark the previous trend. So let's go over to a chart. Let's take a look at how to do this. Oh, let me pop my charts up here. They're just not coming up. There we go. Okay. There we go. Sorry about that. Okay, so we're looking at the Euro US dollar. I'm going to change this over to a 1 hour chart just for simplicity for class tonight. Now we see the prior move. We see the price is now moving in an uptrend. Okay. We want to locate the swing high and the swing low of the previous trend, because this is saying that this price would retrend this level. We want to then locate our Fibonacci tool, which we locate here, and all the charts will give you some wording to locate them. And we want to pull them from the swing low to the swing high point that we designated before. Come on. I'm sorry, there's just something wrong with my mouse tonight. That's why I'm having a problem with these things. There we go. And that's the Fibonacci tool does all the calculations for us, gives us our retracement levels, and gives us all the information we need. Now, I've got mine on a rainbow, but you can pick the colors you want at your levels. You can pick exactly how it wants. Every charting service offers something slightly different. So in order to find these Fibonacci retracement levels, you have to find the recent significant swing high and swing low. Okay. Then for downtrends, click on the swing high and drag the cursor to the most recent swing low. For uptrends, click on the swing low and pull the cursor to the application. So in a downtrend, the rule is we click on the swing high and pull the cursor to the most recent swing low. So we do that by, let's turn on the tool. Take the cursor from the most swing high. Oh, come on, mousey. I'm sorry, I don't know what the problem is with my mouse in the charts tonight, but this is not proper. So we located the swing high, which was here, the swing low, which is here. We pulled our tool down from the swing high to the swing low. So our retracement levels, this is 23.6, which is considered a minor retracement. Then we have the 38.2, which is a major. We have the 50% and the 61.8, and then we have 100%, where the swing high here is equal to the previous swing high here. Now look at this when the price started to retrace. So this was the swing low, and the price started moving in an uptrend. Okay, move straight up from here. Okay, look at what happened at the 61.8 level. Then look at what happened at the 100% level. Look at it, came right down to 61.8. Look how crucial this 61.8 level was in its price movement. Okay, we see some reaction here at the 38, and we see now price, as you can see, push right through all of that. But then look how important that level, these levels came. So there is not one that outweighs the other, but they give us points. So in other words, when the market was reversing and the asset was moving back up, okay, the first place we were looking is the 38.2. We're expecting to see some type of market reaction. We did. We saw it burst right through. Now it hemmed and hawed here for a second, and then it pushed right up to the 50% level. We saw a little bit of congestion there, but not enough to give us anything. But then look at what happened at 61.8, and look at how the markets just sat there. Okay. Look, when it pushed back up, it eased right back down to the 61.8 level, pushed back up again. How crucial that 61.8 level was, and then pushed all the way up. And you notice the swing high, or the high, was not able to make a higher high than it had made previously, and therefore the traders eased back off and left the markets. And where did they let the price recover to? 61.8, and now it's moved back up towards that 100%, even though we're not seeing the momentum at present to push it back up. But we saw how much and how important this level was. But again, there's no rule that it cannot or has to stop. These are levels that just point us in the right direction. So in order to apply Fibonacci levels to your charts, you need to identify the swing high and the swing low. Now, there are several different ways to do this, and the more accurately you can forecast, or the more accurately you pick out the strategic important swing high and swing low. Because just because a price soared up for 1 second and touched a high or made a swing high doesn't necessarily mean it's a important swing high. A swing high is a candle with at least two lower highs on both left and right side of it. A swing low is a candle that has at least two higher lows on both left and right side of it. When using the Fibonacci tool, the probability of Forex trading success could increase when used with other support and resistance levels, trend lines, candlestick patterns for spotting entry and exit points. But the most crucial is locating that significant swing high and swing low. Retracement levels alert traders or investors of a potential trend reversal. Resistance area or support area retracements are based on the prior move. A bounce is expected to retrace a portion of the prior decline, while a correction is expected to retrace a portion of the prior advance. Once a pullback starts, chartists can identify specific Fibonacci retracement levels for monitoring. As the correction approaches these retracements, chartists should become more alert for a potential bullish reversal. The inverse applies to a bounce or a corrective advance after a decline. Once a bounce begins, chartists can identify specific Fibonacci retracement levels for monitoring. As the correction approaches these retracements, chartists should become more alert for the potential bearish reversal. So as we can see here in the 3M chart, we see the retrace around 50% of its prior decline. So Here we had located the significant swing high and a significant swing low. We put our Fibonacci level on here, and then as price moved up, look at what happened. It moved up to the 50% level, was not able to sustain it, and fell down below that 50% level. So if we had entered the markets as it was recovering and moved up, we would have been waiting for some type of action at the 38.2. Do we want to stay in the market? Do we want to exit the market? Or if we were looking to enter the market, do we want to, is it going to bounce off of here and retrace, or is it going to continue going up? As it moved to that 50% level, it gave us another thing. It was not able to reach the 61.8. So that's telling us that uptrend is relatively weak, and then it was able to bounce off the 50 and come below 38.2. So if we had actually been in the markets here, we definitely would have been selling somewhere around this level because we couldn't see the potential for continuing forward in the markets. Now, keep in mind that these retracement levels are not hard reversal points. Instead, they serve as alert zones for potential reversals. It is the point that traders should employ other aspects of technical analysis to identify or confirm reversals. These may include candlesticks, price patterns, momentum oscillators, or just simple moving averages. The Fibonacci tool on most charts shows 4 common retracements. The 23.6, which we consider a very shallow retracement, the 38.2 and the 61.8, which stem from ratios found within the Fibonacci sequence. The 50% retracement level is not based on Fibonacci. Instead, this number stems from Dow theory's assertion that the averages often retrace half of the prior move. So based on depth, we consider the 23.6 retracement to be relatively shallow and such, and they reach that point so quickly that sometimes we can't even do any proper analysis. Such retracements would be appropriate for flags or short pullbacks. Retracements in the 38.2 or 50% range are considered moderate. And even though deeper, the 61.8 retracement can be referred to as the golden retracement, it is, after all, based on the golden ratio. Shallow retracements, which is a 23.6, occur, but catching these require a closer watch and quicker trigger fingers. The examples below, and which we'll go over in a second, use daily charts covering 3 to 9 months. Focus will be on the moderate retracement from 38.2 to 50% or the 61.8. In addition, these examples will show how to combine retracements with other indicators to confirm reversals. So our chart on target. Now, fibs work in any market, whether you're looking at stock market, whether you're looking at the equities market, whether you're looking at cryptocurrency, you're looking at Forex, or you're looking at futures and options. So we can see here on this target price level, we have our fibs. They're drawn on the chart. Now we also see a wedge forming in price. We also have other indicators. So our wedge formation, well, first of all, our price off of the fib level. Okay, so we see price falling down to the 23.6 level and bouncing off of there and then moving back down. We have the wedge, which is indicating a downward trend, and we're looking for the momentum breakout there. We see the price doesn't fall below, doesn't even violate the 38.2 level. It's very supported there and moves back to an uptrend. So this gives us a fairly good indication that the trend would continue and we would move into a buy pattern. Oh, let me get my marker off here. Okay, then we're going to look at another moderate retracement, and we put our fib levels on here, and we have our 61.8, our 50, and our 38.2 in a downtrend, and We see price moving down. Look at the reaction here at the 50% level. Then we see another reaction at the 38.2 level. It falls down here to the 0 level, then moves back up, and it starts to form a flag. Starts to form a flag pattern. It comes back to that 38.2, bounces off 38.2, and moves down to a hardcore downtrend. Okay, so these served as a support and resistance. And look at this, when it bounced off that 38.2, we knew it was going to return to its continued down pattern. We also have an overbought signal here. Okay. And we have our resistance level brought out here, which is supporting our 38.2 from the previous swing lows that we could see in the previous pattern. So combined together, we got a pretty good indication of what was going to happen with this at the stock. So another chart shows bottom is 68.2. So here we have a pretty busy chart. Now, one of the best tools to combine this together is with volume indicators, because we should see volume support the price movement. So here's our 0 at 23.6, our 38.2, our 50, our 61.8. Price moved up, came back down to conjunction, bounced off of the 50% level, moved back up, right up to 23.6, wasn't able to break below it, came back down and came all the way down here to 61.8, bounced off it, and then we got a breakout here and moved back into its uptrend. But look at the surge in volume we got along with the breakout here. So if you've been paying attention in class, you know by now that you can combine the Fibonacci retracement tool with support and resistance levels, trend lines to create a simpler but an awesome trading strategy. When combining the Fibonacci retracement tool with candlestick patterns, we are actually looking for exhaustive candles. If you can tell when buying or selling pressure is exhausted, it can give you a clue of when price may continue trending. Now, how do we use these to make trades? So how do we use fibs to find entry points, exit points, or help us set our stop loss? So let's talk about using fibs in the beginning to set our stop loss. Using the Fibonacci stop loss approach is essentially, or especially interesting, because it offers a more objective way of placing stops. Whereas the trader has to make decisions subjectively when to move a stop based on the moving average or swing strategy, Fibonacci levels don't have this component. Once a trader has drawn its Fibonacci levels, they don't move anymore, and potential stop losses are well defined. In the example below, the trader drew his Fibonacci tools during the downtrend and then used the retracement levels on the right to trail his stop loss. The trade exit happened once price failed to move above the next retracement level. The first method is to set up your stop just past the next Fibonacci level. If you're planning to enter at the 38.2 level, then you would place your stop slightly beyond the 50% level. If you felt like the 50% level would hold, then you might want to move your stop past the 61.8. Simple, isn't it? Now, if you want to be a little bit safer, another way to set your stop loss would be to place them past the recent swing high or swing low. This type of stop loss placement would give your trade more room to breathe and give you better chance for the market to move in your favor. The truth is, just like in combining the Fibonacci retracement tool with support and resistance trend lines and candlesticks to find a better entry, it would be best to use your knowledge of these tools to analyze the current environment to help you pick a good stop loss point. As much as possible, you shouldn't rely solely on Fibonacci levels as support and resistance points as the basis for your stop loss placement. Remember, stop loss placement isn't a sure thing. Now, the first thing you should know about the Fibonacci tool is that it works best when the Forex market is trending. So the idea is to go long on a retracement at a Fibonacci support level when the market is trending up, or go short on a Fib retracement level when the resistance level when the market is trending down. We don't draw Fibonacci grids just for the fun of it, but it's always for a specific purpose, and always after we discern what a strong price swing has completed. And we want to enter a trade, but we don't know where the price might reverse, giving us the lowest risk entry. So let's assume that we found an uptrend. We wait for a correction to enter a long position. A correction is shallow, only the 38.2 retracement line. We go long now, and there is a question, when to close our trade. Many traders follow the rule that the move up from 38.2 retracement may end at the 138.2 extension. Now, anything beyond 100% is continued up at the 31.8, 150 to 1, but those are considered extensions because they're extending beyond the prior price move. So when the correction is deeper, there's a greater chance that the continuation of the main move will be stronger. As you can see in the table, a correction to a 51.8, a 61.8, or 78 retracement may lead to a stronger move up to the 161.8. Now, you have seen some examples of the situation when the connections between the correction and the extension movements are very accurate. There are also cases when they're not so useful. So whenever you are in doubt when to close your trade, it is wise to follow the rule. When you're placing an exit order, it is a good idea to place it just before the level you plan to exit at. You should practice it yourself, but my advice is to place exit orders a few points earlier than the exit level. When you are placing an exit order, it is a good idea to place it just before the level you plan to exit. You should practice it yourself, but my advice is to place exit orders a few points earlier than the next level. These are for two reasons. Sometimes the price will not touch the extension line. Like in the previous example, it may miss it just by a few points, and it will still be a valid move into the Fibonacci extension level. Because remember, these numbers are not written in stone and not stone cold hard exact science. Another reason is that when the price reaches a certain extension level, you're not only the only one trying to exit. The price might just touch that line and move back fast, and your close order may not be completed. By setting an exit point just in front of the extension line, you increase your chances to close your trade with profits. Sometimes the price will not touch the extension line, like in the previous example, and may miss it just by a few points. Exiting a trade is very important, yet it is not so easy. We want to exit at the very best moment, but it's hard to tell when this moment comes. What is worse, the price very often climbs slowly to a certain level, and then suddenly it can fall hard. So trying to exit at the top does not make sense because there is always a chance that there's another top, and this one is not only a stop. Be more concerned about catching tops. In order to find a good exit point, we have to connect the Fibonacci extension levels, technical analysis, and money management. Any exit plan is better than simply letting the trade run and hoping for the best. Thanks to the Fibonacci extension, we get potential levels where the price will stop, or where even the whole trend can stop and reverse. As you have seen in the previous notes, it can be very accurate. The problem is that we do not know which of these levels will work. That is why we use money management. You can read more about this on the internet. When it looks like that you have been correct and your trade is profitable, you just move your stop loss to the entry point. This way, even when the price moves back, you will protect your capital. Fibonacci retracements are often used to identify the end of a correction or a counter trend bounce. Corrections and counter trend bounces often retrace a portion of its prior move. While short 23.6 retracements do occur, the 31.8 and 61.8 level covers the more possibilities with the 50% inside. This zone may seem big, but it's just a reversal alert zone. So remember, other technical signals are needed to confirm a reversal. Reversals can be confirmed with candlesticks, momentum indicators, volume, or chart patterns. In fact, the more confirming factors, the more robust the signal. Now remember, Fibonacci's will help you see retracements as well as reversals. So use these, but use them in combinations with other indicators. And on that note, thank you very much for joining us. Go to www.alvexo.com and use their trading academy, and you'll see videos in each part of this broken down. You'll see examples, and you can also download an ebook that'll show you how to do this step by step, because you're not going to master Fibonacci retracements in just one class. You'll learn how to put them on your charts, which you saw. They're not difficult to put on your charts, but learning how to use them takes a little bit of time and practice. So good night now, and thank you very much for joining us.